Hello, welcome back everyone. In this video, we're going to continue with Chapter 9, Purchasing, Financing, and Insuring a Home. In this video, we're going to go over different types of mortgages and how to compute an amortization table. Let's get started. Mortgages can be classified by two ways. The first is whether or not the loan is guaranteed or insured by the federal government. The second is by the size of the loan. Loans that are below a certain size is considered conforming. Loans that are larger than that is called non-conforming or jumbo loans. The Federal Housing Finance Agency sets the limit for what is conforming and what is jumbo. And this limit varies by different regions in the country. This is perhaps not surprising. The regions that has the highest housing value also have higher limit. So for most of the country, basically everywhere, the loan limit, this is 2025. It does change every single year. Is any loan up to $806,500 is considered conforming. And then for some region in New York, San Francisco, Alaska, Hawaii, they are a little bit higher. In the Boston area, up to the Seacoast, up to Seacoast, New Hampshire, the limit is also higher. It's up to $1 million, and this is a loan amount. This is not the housing value. You can go to this web address to see what the latest limits are. And this map is actually interactive. You can highlight where you're looking at and find out that particular area. You can also click on the highlighted area to find more information. I encourage you to go to this website and try it out on your own. Now let's look at different types of mortgages. Conventional mortgage are mortgages that are not guaranteed by the U.S. government. So not insured, non-guaranteed. These mortgages can be fixed rate or adjustable rate. And so these are conforming mortgage, means they are below the limit set by the Federal Housing Authority. And also they are conventional, meaning that they are not insured or guaranteed by the government. Conforming conventional mortgages are the most common type of mortgages. These are mortgages that are specially designed for borrowers that have good credit scores and also can afford a reasonable down payment. Reasonable meaning anywhere from 5% to 20%. There are additional guidelines that governs this type of loans. They are set by two agencies. They're called Fannie Mae and Freddie Mae. Both of them are GSE. GSE stands for Government-Sponsored Enterprises. Even though the name government is in this type of enterprises, they are not directly affiliated with the government, and these loans are not insured or guaranteed by the government. So Fannie Mae and Freddie Mac these are the minimum. So these are the minimum credit score must be 620. Usually people who qualify for conforming conventional mortgages has a credit score higher than 660. They must have a debt to income DTI ratio of less than 36%. Remember, in the criteria, we use 30 to 35%. So 35% is a little bit conservative, and you don't want to be just squeaking under. So if your DTI ratio is less than 35% and you have a credit score in the 700s, then you're in very good shape. They also require 2 or more years of consistent income and employment, and a down payment of at least 5%. So the good credit and reasonable down payment, and also verifiable income. Verifiable income means either a letter from your employer, your W-2 tax form, or your 1099 if you are a self-employed entrepreneur or you work as an independent contractor. If you do not qualify for the conventional conforming mortgages, there are other options. You can look into government-insured or guarantee programs. One restriction across all these mortgages is that they must be your primary residence. The first type of government loans, and is very popular, is VA loans. These are for veterans. So VA stands for Veterans Association loans. They do not require any down payment, and they don't require private mortgage insurance regardless of down payment. If you're a veteran, this is a great option even if you qualify for conventional mortgages. Another government agency that issues loans is the USDA. So this is the U.S. Department of Agriculture. They have two types of loans. They have the direct loans. This is the only loan that is issued directly by a U.S. government agency. A VA loan provides guarantee or insurance. But you still obtain the loan from a conventional bank or a mortgage broker. USDA direct loans has very strict requirement on both the property and your household, not just income, but characteristics as well. If you do qualify, it does not require any down payment. They don't have any closing costs, and they even have mortgage payment assistance. USDA direct loans are specifically designed for low-income family living in rural areas. USDA has another type of loan. These are the guarantee loan. So these are loans, again, that are given through banks with the government guarantee. It's designed for, again, to help lower income family. Your household income must be less than 115% of the area's median income. So this is not particularly low income, but lower income. The property has to be in eligible area, and this is not just rural. There are many areas that actually qualify for USDA guarantee loan. It does not require down payment, and it also accepts lower credit scores. They do, since these are U.S. guarantee loan, they don't require private mortgage insurance, but they do require an insurance premium that you pay to the administrator of these types of loans. They are similar and sometimes less than PMI. The most common of government guarantee loans are FHA loans. FHA loans are designed for home buyers that have a slightly lower credit scores and down payment. They would allow down payment up as low as 3.5% if your credit score is at least 580. They'll require a 10% down payment if your credit score is only 500. 500 is very, very low. 500 is oftentimes the credit score for someone who has filed for a bankruptcy recently. Because this is a government guarantee, you do not require private mortgage insurance, but you do have to pay a mortgage insurance premium to the administrator, to FHA, and the amount of that insurance is comparable to a PMI. Even though your credit score or the borrower for FHA loan has much lower credit score. One thing that is important to take into account is that FHA loans sometimes can actually be more expensive than conventional mortgages. However, it is loan that is available to borrowers who do not have good credit or do not have enough down payment. So if you have good credit and you have a reasonable down payment of 5% or more, you may be better off going with a conventional mortgage. The last type of mortgage is non-conforming conventional mortgage. Conventional means that, again, they are through banks and they don't have any guarantee from the government. Non-conforming simply means that they don't satisfy any of the requirement by the GSE, or Fannie Mae or Freddie Mac. So any loan that does not meet the criteria that we talk about. There are some examples. Jumbo loan is the most common type of non-conforming loans, simply because the loan amount is higher than the limit. Other loans include subprime. Sometimes they are called Alt A. So A means good credit. Alt A means not very good credit. Subprime loans, so these are borrowers whose credit scores is below the 660 that is required by Fannie Mae and Freddie Mac. And these are issued not by the government, so they are conventional. There are other types of loans. We'll explain what these are. Graduated payment mortgage, mortgage payment loans whose mortgage payment is smaller in the beginning and then increase over time. So this is not a fixed mortgage. It's not a variable rate mortgage either. The amount increase is not based on the interest rate, but rather is designed to be smaller in the beginning and increase over time. Balloon payment mortgage are mortgages that at the end of when the mortgage is due, it still have a large outstanding balance. That's what the balloon is. The balloon means that you do not fully pay off the loan over the life of the mortgage. This an even more extreme form is interest-only mortgage. Here you're paying only the interest payment each month. You do not pay off any principal, and therefore you're not paying off the loan at all. For non-conforming, we mentioned conforming conventional mortgage, and that is issued by government-sponsored enterprises such as Fannie Mae and Freddie Mac, and then government guarantee mortgages such as VA loans and FHA loans and USDA loans. All of those loans, the money comes through those enterprises or the government via banks. So you still obtain the loans from the banks or mortgage companies, but the money for those loans come from either the GSEs or the government. Another type of loan is portfolio loans. Portfolio loans may be conventional or they may be non-conforming. Portfolio loans, the money comes directly from the lenders. And because the money comes directly from the lender, there is some potential for negotiation. These portfolio loans are particularly useful for borrowers that have very unique financial situation, such as their incomes may not be fully documented because they have a lot of private investments, or if they need very large loans way above the conforming limit. Another source of loan is PLS loans. They tend to be for non-conforming mortgages such as jumbo loans or subprime loans. The word PLS stands for private labeled security. So this is back in the financial crisis. This is famous for the mortgage-backed security, for example. And this is mortgage-backed through private investors, not government-sponsored enterprises or government agencies. Here's a summary of the mortgage requirement by different loan types. So here are the minimum requirement, but you can see this is the actual average from 2023. So for conforming conventional loan, even though the stated minimum is 620 for your credit score, the average borrower's credit score is 738. It's slightly lower for VA loan and much lower for FHA loan. As we mentioned earlier, for FHA loan, the minimum credit score is 580 if you put down 3.5%, and 500 if you put down 10%. But the average credit score is actually 645. And for USDA guarantee loan, the average credit score is 684. This just tells us that even though this is the stated minimum, this is what is actually being approved by the lenders. Here's the origination by loan type, meaning how much mortgage were given out by different types of loan. As you can see, GSE stands for the conventional conforming mortgages. They represent the majority. And the next is government sponsor. So this includes VA, FHA, and USDA loan. That's the second amount. Private portfolio is the third category, and jumbo loan is quite small. And you notice that particularly the other types of loan or jumbo loan, they are much smaller after the financial crisis. Prior to the financial crisis, private label loans were much higher, and that is part of the causes, particularly the subprime loans is part of the reasons, not all of it, but part of the reasons for the financial crisis. The financial crisis of 2008 taught us a lot of important lessons about buying a home and mortgages. First is that during economic downturn, house prices can drop significantly. And in that situation, if you take out a loan that has very small down payment, you can end up having a loan greater than the value of the house. And that's sometimes referred to as upside down, just like a car loan, or underwater. As a result of the financial crisis, the government has increased consumer protection, particularly in the mortgage application process. They require more disclosure from the lenders and also requires borrowers to provide more documentation to show that they can afford the mortgage. In particular, they prohibit predatory practices, meaning they prevent lenders from giving out mortgages to people who simply cannot afford them. You can see that overall, these are the quarterly percentage change in house prices. Most of the time, house prices go up. So it is true, the conventional wisdom that buying a house is a reasonable investment. We will talk about investing in a future chapter. But buying a house is one form of investment, and in most years it does go up. It's not a whole lot, about 1% per quarter, 1.5% to 2% per quarter. So that's about 4 to 8% per year. Most of the time it's closer to 4%. In some years, it can be very, very high. However, economic downturn can result in a great drop in housing prices, just like it can result in a big drop in stock prices. So houses is a little bit safer than stock because again, the increase is not as high and the decrease is not as great, but it's still risky. If you look at the cumulative decrease during the financial crisis from 2007 to 2011 is close to 19%. So the house value dropped by almost 20%. So a $500,000 home at the beginning of 2007 would be worth only $400,000. So you lost $10,000. If your down payment is only, say, $50,000, then you'll be $50,000 underwater. Some areas experience much greater drop. The two areas that historically has the greatest fluctuation in housing prices are Las Vegas and Miami. Las Vegas, during that time, the house price dropped by as much as 59%. So they lost 60% of their value. In response to the financial crisis, the government now requires lenders to disclose whether or not the mortgages they are giving out are qualified mortgage. Qualified mortgage means that they meet the ability to repay standard. So that means that the lender must verify the income and asset of the borrower. So when you apply for a loan, you should be prepared to provide your lender with your income and expenses as well as assets and liability. The good news is you already know how to create your personal statement of net worth, which will list all your asset and liability. And you don't have to show your lender the expenses, but you should prepare to be able to show them income, documented income, such as a W-2 form and a 1099 form or a copy of your tax return. For adjustable rate mortgages, the ability to repay is evaluated based on the maximum interest rate during the first 5 years of the mortgage. And they also put limit on the DTI ratio for the borrower. So again, the 35% is important. They also limit the type of loan features. A mortgage that has this risky feature cannot be a qualified mortgage. Risky features include negative amortization, interest-only loan, or balloon payment loan. We'll go over example. So negative amortization can happen if your payment, remember those graduated loan payment, if your initial loan payment is not enough to cover interest, then you'll have negative amortization because the unpaid interest will accumulate future interest. That's negative amortization. And any loan term that is longer than 30 years. In addition to that, a mortgage, they put limit on how much they can charge for points and fees. So points and fees cannot exceed 3% of the loan amount. So if a loan meets all of these criteria, they are considered a qualified mortgage. If you have a good credit score and you can afford a reasonable down payment, it's a good idea to make sure that when you're shopping for mortgages, ask, is this a qualified mortgage? If this is a qualified mortgage, you will be assured that it doesn't have some of the risky features and that you are not being charged excessive points and fees. When you're ready to shop for a mortgage, be prepared for the following. Lenders is going to require some documentation. So your personal financial statement that you prepared in earlier chapters, including the statement of net worth, and also W-2 or 1099 forms, as well as bank statements. So these are all documentation of your income and asset. They will typically obtain a credit report and verify the information on the application. So it's a good idea for you to get your own credit report first and verify that there's no error before you start shopping for a mortgage. You should compare lenders before getting a pre-approval. When you get a loan estimate, so not a pre-approval, make sure that they only do soft credit inquiries. So when you either check a box online or sign an agreement to get the pre-approval, make sure you double check that it is only soft credit inquiries, because if you do a hard inquiry, that can reduce your credit score. So if you get a formal pre-approval, they will do a hard credit inquiry and your credit score will drop temporarily. After a few months, it will return to normal. But if you decide to go with a different lender, for example, or you did not like the lender that you get the pre-approval from, the next lender may be looking at a slightly lower credit score. So you want to be sure that you are happy with the terms that you're given before you get a pre-approval. The Consumer Financial Protection Agency has an excellent tool that helps you understand what loan estimate look like. And it's actually, it is interactive, so you can click on each part and it will tell you what those terms means. I encourage you to go to the website. The link is included in the slide to learn more about what a loan estimate looks like. We'll end the video here. In the next video, I'm going to go over how to compute an amortization table. See you soon.